Okay, welcome to part 3 of the art of trading corrections, trading non-ideal corrections. In part 1, we learned how to trade ideal ABC corrections. The reason they are called ideal is because they completed in both the typical time and price targets for an ABC correction. As many of you already know, the markets do not unfold ideally all the time. So we're going to learn how to trade non-ideal ABC corrections in this part. Non-ideal meaning they don't end in the typical price and time targets for an ABC correction. And then we're going to also look at complex corrections, trade strategies for corrections that have more than 3 waves. Let's go ahead and get started. While trading ideal ABC corrections have very high probability outcomes, if you were not to consider non-ideal ABC corrections, you'd be passing up many great trade opportunities. So let's go ahead and look at some maximum price and time targets for an ABC correction. As you may recall from part 1 of the art of trading a correction, the typical price target for a correction is the 50 to 61.8% retracement zone of the previous trend. Well, the maximum price target for a typical correction is the 78.6% retracement of the previous trend. Let's go ahead and look at some examples of the 78.6% retracements. Okay, we're looking at a US dollar daily chart right now. This is continuous futures data. As you can see, a nice 5-wave impulsive rally unfolded off its December 2004 low to November 2005 high, followed by a potential ABC corrective decline into this June low. I'm going to go ahead and put up the typical price targets for a corrective decline. That's the 50% retracement to 61.8% retracement zone of the December 2004 to November 2005 rally. And as you can see, the dollar declined right through this high probability price target, but tagged the 78.6% retracement, which is typically the maximum price target for a ABC corrective decline. The June 5th, 2006 low was actually 2 ticks above that 78.6% retracement zone. Okay, this next example that we're looking at is AU, Anglo Gold Ashanti. It's a daily chart. It's a gold mining stock. And as you can see, we have an impulsive decline off this February 2nd high to the March 10th low, and a potential ABC corrective rally complete that rallied right through the 50 to 61.8% retracement zone of the February 2nd to March 10th decline, typically the typical price target for a corrective rally. Rallied right through that typical price target for a corrective rally and made a high slightly below the 78.6% retracement of the February 2nd to March 10th decline. I'm going to go ahead and take off the typical price target. While it didn't hit the 78.6% retracement, if we go ahead and put up the 100% alternate price projection of wave A, which is the typical price target for wave C, if you recall from part 1 of the art of trading a correction. And as you can see, that's at 58.40, the May 11th reversal day high was 4 ticks below that typical wave C target. While AU did not make an ideal ABC corrective rally because it did not complete in the 50 to 61.8% retracement zone of the February to March decline, it did have a reversal day high slightly below a high probability price target, which includes the 100% alternate price projection of the wave A rally, the typical wave C target, and the 78.6% retracement of the February to March decline, typically the max target for a corrective rally. And we had a daily DT oscillator bearish reversal. While this is not an ideal ABC corrective rally, it was still a great opportunity to enter a short position. Let's go back to the dollar daily chart and see where the 100% alternate price projection, the typical wave C price target, fell. 100% alternate price projection was way up here. That's at 86.34, and as you can see, the dollar declined right through that price target. But the 162% alternate price projection of the wave A decline was slightly above the 78.6% retracement. Guess what this 162% alternate price projection of wave A is? That's right, the max price target for a typical wave C is the 162% alternate price projection of wave A. Let's look at a couple more examples. This is S&P E-mini 60-minute data. Nice 5-wave decline from the June 2nd high down to the June 6th low, and there appears to be an ABC corrective rally unfolding off the June 6th low. The high so far of June 7th tagged the 50% retracement zone to the tick of the June 2nd to June 6th decline. And right above the 50% retracement is the 162% alternate price projection of this wave A rally off the wave B low. So the max price target for a typical wave C is 1284.75 to 1287.00, which includes the 50% retracement of the June 2nd and June 6th decline, and the 162% alternate price projection of the wave A rally off the wave B low. And as you can see, that was the completion of the wave C high. Okay, let's take a look at another stock. This is Adobe, ADBE. This is a daily chart we're looking at. This July 21st low is in the typical price target for a wave C low, which includes a 100% alternate price projection of the wave A decline off the wave B high and the 50% retracement of the March 11th to June 7th previous trend. Also the lows in the typical time target for a corrective decline, which is the 38.2 to 61.8% time retracement zone of the March 11th to June 7th rally. Also the daily DT oscillators in the oversold zone. Go to the weekly chart. As of the week ending July 23rd, the weekly DT oscillator is also in the oversold zone, signaling a low lasting several weeks should be at or near completion. So all conditions are in place for a wave C low. Let's go ahead and add a bar. Whoop, this typical wave C price target's taken out. So let's go ahead and put up the max price target for typical wave C. There's all the retracements, and there's 162% alternate price projection of the wave A decline, and that's closest to the 61.8% retracement. So the max price target for a typical wave C is the 61.8% retracement of the March 11th to June 7th rally and the 162% alternate price projection of this wave A decline off the wave B high. This is the next high probability time target for a low lasting several days, and with the 8 weekly DT oscillator in the oversold zone, a probable low lasting several weeks. Go ahead and add some bars, and here we have July 26th low is 2 ticks above this max price target for typical wave C, where also we remain in the typical time target for a corrective decline, the 38.2 to 61.8% time retracement zone of the March 11th to June 7th rally. However, 13 daily DT oscillator remains in the oversold zone. We're waiting for a 13 daily DT oscillator bullish reversal. which happens following the next daily bar. So a good trade strategy would be to place a trailing 1 bar high buy stop to enter a long position, 1 tick above the current bar's high. Triggered the next day, protective sell stop should be placed 1 tick below the July 26th probable wave C low. And as we see, we have a rally to above the June 7th high as anticipated. This trade had very low capital exposure, as you could see, with very high profit potential. A wave C corrective low should be followed by a rally above the high of the previous trend. And with all the conditions in place for a corrective low, we had the 8-weekly DT oscillator in the oversold zone. We had the 13-weekly DT oscillator bullish reversal with a price low and the max price target for a typical wave C. Very high probability trade, low capital exposure, high profit potential. Okay, we're now looking at Euro Swiss franc cross daily Forex data. As you can see, as of the April 27th high, the 8 daily DT oscillators in the overbought zone, signaling a multi-day high, should be at or near completion. Let's go down to the 60-minute time frame. Here's this April 27th high shown in the daily chart. Potential impulsive decline off the April 4th high to the April 18th low. Potential ABC corrective rally at or near completion off the April 18th low. Wave A subdivides in a nice 1, 2, 3, 4, 5 wave impulsive pattern, and wave C off the April 24th wave B low appears to be unfolding in a 1, 2, 3, 4, 5 wave impulsive pattern. As you can see, this April 27th high has exceeded the 78.6% retracement, which is usually the maximum price target for a corrective rally, but it remains within the typical price target for a wave C rally below the 100% alternate price projection of the wave A rally. So it should still be considered for a short position, especially with a 5-wave impulsive rally unfolding off the April 24th low. With the 8 daily DT oscillator in the overbought zone and the 34 60-minute DT oscillator bearish, a decline below the April 27th wave 4 of C low signals wave 5 of C should be complete and is a good short trade setup. Sell stop to enter a short position should be placed 1 pip below the April 27th wave 4 of C low. If a short trade is triggered, a protective buy stop should be placed 1 tick above the potential wave 5 of C high. That's great capital exposure for a profit potential. That's pretty good following a decline below the April 18th low. Let's go ahead and see what happens. Short trade triggered. Protective buy stop placed at 1 tick above the April 27th high. The potential wave 5 of C high. Here we go. We got a decline below the April 18th low. Low capital exposure, great profit potential, high probability trade with the daily momentum bearish, the 34 60-minute DT oscillator bearish reversal, and the April 27th high in a high probability wave C high. Before we get into some timing, let's go ahead and look at that US dollar example we looked at in the beginning of this section. Okay, here's the US dollar example that we were showing before, but this is a weekly instead of a daily chart. Here's the June low, potential wave C low, and the maximum price target for a typical wave C, which includes the 162% alternate price projection of the wave A decline and the 78.6% retracement of the December 2004 to November 2005 rally. The reason I'm showing this example again is most of the examples I have shown in this three-part tutorial series have been after the fact examples in order to demonstrate ABC corrections and demonstrate different trade strategies. This recording today is done on June 27th, 2006, and this data is current as of yesterday. So if this June low is a wave C as anticipated, a multi-month rally to above this November 2005 high should follow. The weekly DT oscillator is bullish right now with only the fast line in the overbought zone, signaling that this rally off the June 9th low should continue for a few more weeks. This is as real time as it gets in this tutorial because it's a longer term example. Let's go down to the daily chart now. Okay, here's the daily chart from the November 16, 2005 potential wave 5 high down to the June 5th, 2006 potential wave C low. As you can see, the decline off this March 13th wave B high subdivided in a 1, 2, 3, 4, 5 wave decline, and this June 7th high has taken out the June 1st potential wave 4 of C high, signaling that June 5th should be the wave 5 or C low. The daily DT oscillator also has made a bullish reversal in the middle of the oscillator range, and as you recall, the weekly momentum is also bullish. This is a good place to trail a 1-bar high buy stop to enter a long position for a potential rally above this November 16, 2005 high. Okay, let's go ahead and add some bars. And a long trade would have been triggered. Protective sell stop 1 tick below the November 5th wave 5 of C low. And there we are as of today's data. So this will be interesting to see if our analysis is correct, if this is a wave 5 of C low as anticipated, and if there is a rally above the November 16, 2005 high. So even if our analysis is not correct and this June 5th low was taken out, let's see if this was a good trade setup. We had the weekly momentum bullish. We had a daily DT oscillator bullish reversal. We had a rally above this June 1st wave 4 of C high, signaling this wave 5 of C low in high probability wave C price target should be complete. We have nice capital exposure, and we have great profit potential for a rally above this November 16, 2005 high. This is all you can ask for in a trade strategy. High probability trade setup, low capital exposure, great profit potential. Let's now get into some timing. As you recall, the typical time target for a correction is a 38.2 to 61.8% time retracement zone of the previous trend. The maximum time target for a typical corrective decline or corrective rally is the 100% time retracement of the previous trend. Let's go ahead and look at some examples. Okay, let's just rattle off a few examples here showing that the 100% time retracement is a very common time target for a corrective rally. Not quite as common as the 38.2 to 61.8% time retracement zone, but common nonetheless. This is a silver daily chart we're looking at right now, and as you can see, this ABC corrective rally to the May 11th to May 19th decline tagged the 100% time retracement of the May 11th to May 19th decline. That was on May 30th, followed by a decline below, well below the May 19th low. This next example is GILD. This is a biotech stock daily chart. And as you can see, the December 19th low was in the typical price target for a corrective decline, the 50 to 61.8% retracement zone of the October 19th to November 17th rally, and the corrective low on December 19th tagged the 100% time retracement of the October 19th, November 17th rally, followed by a rally well above the November 17th high. Okay, let's look at another example in a different time frame. This is 60-minute Diamonds data. Diamonds is the Dow Jones ETF. And as you can see, a potential ABC corrective decline to the June 14th to June 15th rally is at or near completion. 60-minute DT oscillator made a bullish reversal, and the June 19th low is in the maximum price target for a typical wave C, which includes the 162% alternate price projection of the wave A decline and the 50% retracement of the June 14th to June 15th rally. Also, this June 19th low tagged the 100% time retracement of the June 14th to June 15th rally, typically the max time target for a corrective low. All conditions are in place for a wave C corrective low. If we place the trailing 1-bar high buy stop, one tick above this bar, which was the bar following the 60-minute DT oscillator bullish reversal, let's see what happens. Long trade not triggered. This is the trailing 1-bar high buy stop, so we set it one tick above the current bar. And there we go, it's triggered. Protective sell stop. Place one tick below the potential wave C low. And we have a rally above the June 15th high as anticipated. Okay, what I want to show you with this last example before we get into complex corrections are how often pivot highs and lows are made at or near these time and price targets we've been looking at in the last few sections of these tutorials. This June 19th high, by the way, this is S&P 15-minute data. This June 19th high was one 60-minute bar past the 100% time retracement of the June 15th through 16th decline, and the high was made in the 50 to 61.8% retracement zone of the June 15th and 16th decline. As you can see, there was a decline below this probable wave B low, signaling that June 19th most likely is the completion of the corrective rally to the June 15th to June 16th decline. Okay, I've cleaned up the chart a little bit, and let's just go ahead and add some more bars here and throw up some typical price targets that we have learned. The 78.6% time retracement of the June 14th to June 15th rally, which is the typically the maximum price target for a corrective decline. And we'll put up the 100% alternate price projection of the June 15th to June 16th decline from the June 19th wave C high, which is the typical wave C price target. So we have a potential ABC corrective decline at or near completion. Put up some time retracements here. So while this June 19th low has passed the typical time, the maximum time target for a typical corrective decline, it has tagged the wave C price target, which includes the 100% alternate price projection of the wave A decline and a 78.6% retracement of the June 14th to June 15th rally. And it looks like we probably have a potential wave C low here at the June 19th low. It also looks like this wave C decline potentially unfolded in 1, 2, 3, 4, 5 wave decline, which we've mentioned before is typical of a wave C decline. And if we put up the typical price target for a wave 5, which is the 127% to 162% external retracement of wave 4, we see that this June 19th low actually tagged the typical wave 5 of C target. Okay, I went ahead and cleaned up the chart once again. And let's see if this June 21st high fell on any typical price and time targets. Got the 78.6% retracement of the June 15th to June 19th decline, and the 162% alternate price projection of the January 19th to 20th rally, which falls right upon the 78.6% retracement. 100% time retracement of the June 15th to June 19th decline, and the 100% alternate time projection of the June 19th through June 20th rally. As you can see, this June 21st high tagged the 100% time retracement and was slightly below both the 78.6% retracement of the June 15th to 19th decline and slightly below the 162% alternate price projection of this June 19th to June 20th rally. And it also looks like there's a probable wave 1, 2, 3, 4, 5 wave rally unfolded. Put up the wave 5 price targets. And there we go. June 21st high also tagged that typical wave 5 price target. While there was no oscillator or specific trade strategies in this example, the reason I showed this spider 15-minute chart was to show how often pivot highs and pivot lows are made at or near these high probability time and price targets. So let's go ahead and move on to the last section of the art of trading a correction, complex corrections. Okay, let's go ahead and get started with the final section of the art of trading a correction, complex corrections. Complex corrections are any type of corrections that have more than 3 waves. They come in many shapes and sizes, and most of the corrections out there in the market are complex corrections. I advise you not to try to trade complex corrections until you have successfully traded ideal ABC corrections and non-ideal ABC corrections. Nonetheless, there are many opportunities out there to get into profitable positions trading complex corrections. One of the key factors about complex corrections are taking out the extreme of the previous wave of a complex correction is the initial signal the correction should be complete. Let's go ahead and look at an example. Okay, the first example I have up are bond 60-minute data. As you can see from the May 12th low, a textbook 1, 2, 3, 4, 5 wave pattern to the May 24th high unfolded. If you recall from part 1 of the art of trading a correction, a non-overlapping wave pattern is characteristic of a trend. From the May 24th high, we have small overlapping waves. If you recall from part 1 of the art of trading a correction, overlapping wave pattern is characteristic of a counter trend or a correction. And since there is not a well-defined 3-wave pattern off the May 24th high, this is not an ABC corrective pattern. It has a multitude of small overlapping waves, making it a complex correction. And once a prior minor swing high was taken out, as you can see, none of these prior minor swing highs were taken out, but once this May 31st prior minor swing high was taken out, that signaled June 1st should be the completion of the complex correction. And if we add some bars, you see there was a rally to above the May 24th high, signaling that June 1st was the completion of the complex correction off the May 24th high. And use the same retracements and alternate price projections you use to target the end of complex corrections that you use to target the end of ABC corrections. Let's go ahead and look at another example. This is NASDAQ E-mini 15-minute data. As you can see, from the June 26th high to the June 26th low, we had a decline that has more impulsive characteristics than corrective characteristics, followed by a rally with overlapping waves, characteristic of a counter trend or correction. And since there are more than 3 waves, this is a complex correction rather than an ABC correction. The June 27th high was 1 tick above the 78.6% retracement of the June 26th decline, which is typically the max target for a corrective high. A decline below this minor swing low would be the initial signal the corrective rally off the June 26th low should be complete. Next bar took this minor swing low out, followed by a decline below the June 26th low. Complex corrections to trade are A, B, C, D, E complex corrections, because where they end is very predictable. An A, B, C, D, E complex correction is a 5-wave corrective pattern, but they differ from an impulsive wave because the waves overlap. Let's go ahead and look at an example. This is SPDR's weekly chart, and as you can see, from the August 8th, 2003 low to the March 5th, 2004 high, we have this 5-wave overlapping decline, characteristic of a complex correction, a 5-wave complex correction, an A, B, C, D, E complex correction. Let's go ahead and put up some retracements and alternate price projections. We already have the ABCDE corrective pattern completing slightly below the 50% retracement of the August 2003 to March 2004 rally. And let's go ahead and put some alternate price projections. We have the alternate price projection of the wave A decline from the wave D high. That's the 100% alternate price projection, slightly above the 50% retracement. And we'll also take the alternate price projection of the wave C decline from the wave D high, and there we have another 100% alternate price projection. So we have this high probability price target for the completion of the ABCDE complex corrective decline at 107.59 to 106.65, which includes the 50% retracement of the August to March rally and the 100% alternate price projections of wave A and wave C from the wave D high. So I go ahead and add some data, and that wave D high is taking out the prior minor swing high, followed by a rally to above the March 2004 high, signaling that the August low is the completion of the ABCDE complex correction. Okay, let's look at another example. This is Newmont Mining daily data, NEM. This is a gold mining stock. With this example, I'm going to kill 3 birds with 1 stone. I'm going to demonstrate how to trade ABCDE corrective declines. I'm going to show the importance of trading more than 1 unit. I'm going to show the importance of trading using more than 1 time frame. As you can see, this October 20th low tagged the typical wave 5 of C price target. This includes this 50% retracement of this August 30th to September 30th, 2005 rally. It includes the 162% alternate price projection of the wave A decline, which is typically the maximum price target for a wave C decline, and it also includes the 127 to 162% external retracement zone of this wave 4 of C rally, the typical price target for a wave 5 of C low. October 20th low tagged this high probability price target for a corrective low, and the 8 daily DT oscillator has made a bullish reversal. Set a trailing 1 bar high buy stop to enter a long position for a potential rally above the September 30th high. If a long trade is triggered, you should trade at least 2 units. So a good place to exit 1 unit of the long position to secure some profit in the event our analysis is incorrect would be at the 50% retracement of the wave C decline. Go ahead and add a bar. Long trade was triggered. Once this 50% retracement is reached, we'll trail a 1 bar low, sell stop for half the long position in the event that our analysis is incorrect to secure some profits. Go ahead and add a bar. The gap up open the next day was above the 50% retracement, so the protective sell stop for half the long position is placed 1 tick below the current bar's low, and it's a trailing 1 bar low sell stop for half the long position, and it is exited at the next day's open to secure small profit in the event that our analysis is incorrect and the October 20th low is not the completion of the corrective decline off the September 30th high. Protective sell stop for the remaining half of a long position is 1 tick below the October 20th potential wave C low, potential completion of the corrective decline off the September 30th high. Okay, I'm going to go ahead and clean the chart up a little bit here. We have a protective sell stop for the remaining half of long position, 1 tick below the October 20th wave C low. Let me go ahead and add some bars. And you see the October 20th wave C low was taken out, signaling that October 20th is not the completion of the corrective decline off the September 30th high. However, we still have an overlapping wave pattern. So the assumption remains that corrective decline is unfolding off the September 30th high. So more than likely, this October 25th high should be a wave D high of an A, B, C, D, E complex corrective decline. So this trade most likely broke even or was a small loss because we traded more than 1 unit. This shows the importance of trading more than 1 unit. Let's go ahead and put some price targets up for a wave E target. Okay, I cleaned up the chart. So we have a potential wave E target right here, which includes the 61.8% retracement of this August 30th low to September 30th high. We have a 162% alternate price projection of the wave A decline and a 100% alternate price projection of the wave C decline. Gives us a high probability price target for the completion of the A, B, C, D, E corrective decline. Okay, I'm going to go ahead and add some bars. And we have a low tagging the typical wave E price target. Since the 8 daily DT oscillator is already bullish, a good long trade setup would be a rally above the November 2nd prior minor swing high. Go ahead and add some more bars. And the November 2nd prior minor swing high is taken out. Entering the long position, signaling The November 4th low most likely is the wave E low and the completion of the corrective decline off the September 30th high. Protective sell stop for the long position, one tick below the November 4th low. And you see there was a rally above the September 30th high as anticipated. November 4th low completed the corrective the corrective decline off the September 30th high. Let's go ahead and see what would have happened if we were taking this trade using dual time frames. Let's go to the weekly Newmont mining chart. And you see here is the low of the week ending October 21st. And as of the low ending October 21st, the weekly momentum is bearish. Go back to the daily chart, and this potential wave C low that we were looking at earlier is October 20th. This signals that we wouldn't even consider this long trade. Let's go over and look at the first week of November. November 4th. Here's the low November 4th. Weekly DT oscillators in the oversold zone. So we would have been considering this long trade following the rally above the November 2nd high. So this shows the importance of taking trade strategies with dual time frames. We would have avoided this break even or small loss on this potential wave C low, and we would have waited for this completion of the wave E low before taking the long trade position. Okay, now we're looking at Euro Swiss franc weekly data. As you can see, we have a potential ABCDE complex corrective decline unfolding off the February 2005 high. Let's go ahead and throw up some price targets. Also the 100% alternate price projection of wave A from the wave D high, following the 78.6% retracement, and the 100% alternate price projection of the wave C decline from the wave D high, which falls right by the 61.8% retracement of the November to February rally. I'm going to go ahead and change this to blue. So we have each price target has different colors. So we have two price targets right now. We have a price target that includes a 61.8% retracement of the November to February rally and the 100% alternate price projection of the wave C decline from the wave D high. And the second price target includes a 78.6% retracement and the 100% alternate price projection of the wave A decline from the wave D high. More than likely, this wave E low will complete in one of these two price targets. These are two very high probability price targets with the retracements and the alternate price projections. And add some bars. We have a reversal week low tagging the first price target that includes the 61.8% retracement. But the weekly DT oscillator is bearish, so we're not going to consider any long position at this time. And here we have a weekly DT oscillator bullish reversal. We can look at two trade strategies. We can look at a trade strategy on a rally above this wave D high, entering a long position. That's rather large capital exposure, so we can go down a time frame. Okay, here's the Euro Swiss franc daily chart. Here's that ABCDE complex corrective decline unfolding off the February high, and here's the June potential wave E corrective low. We know that the weekly DT oscillator is bullish, so a good long trade strategy to reduce our capital exposure would be following an 8 daily DT oscillator bullish reversal. There we have an 8 daily DT oscillator bullish reversal, and it is in the 50 to 61.8% retracement zone of the June 7th to June 17th rally. So a good long trade strategy would be to place a trailing 1 bar high buy stop to enter a long position. Long position triggered on the next daily bar. Protective sell stop should be 1 tick below this June 24th low. And you can see that this capital exposure is a lot less than the capital exposure if we would have waited for a rally above the May wave D high. And let's go ahead and go back to the weekly chart, and we see we had a rally above the February high as anticipated. Okay, let's go ahead and have a quick review of what we learned in part 3 of the Art of Trading Correction. The max time and price targets for a typical correction is the 100% time retracement and the 100% price retracement of the previous trend. The maximum price target for a typical wave C of a correction is the 162% alternate price projection of a wave A. While ideal ABC corrections are higher probability trade setups, there are many high probability trade setups with low capital exposure with non-ideal ABC corrections and complex corrections. However, I recommend not trying to trade non-ideal ABC corrections or complex corrections until you have successfully traded ideal ABC corrections. Well, this concludes the Art of Trading Correction tutorial series. Now you should have a basis and basic understanding on ABC corrections and trade strategies that can help put you in the positions in the direction of the main trend. Apply this to a disciplined money management plan can result in a very profitable trading career. If you'd like to further your education, visit us at www.dynamictraders.com and check out one of our advisory reports and see these trade strategies and patterns used and unfold in real time. Thank you very much.